In today's video, we'll explore how major traders use liquidity sweeps to deceive retail traders in the market, and we'll likewise describe in depth how you can evade this trap. But before proceeding further, if you find this topic valuable for you, make sure to click the like button. And if visiting first time, don't forget to subscribe and turn on notification bell so you never miss our newest update. I'll meet you after intro and disclaimer. What is a liquidity sweep? While trading, you may have frequently observed the market climbing upward, forming a bullish structure. But suddenly, at a certain point, the price drops aggressively and breaks its recent swing low. Seeing this, many retail traders assume a bearish trend might begin in the market and enter a short trade. But the price forms a few candlestick patterns near the breakpoint of that swing low and resumes its earlier uptrend, trapping many retail traders. I believe many of you traders have likely faced this in your own trading. In the smart money concept, this trapping is referred to as a liquidity sweep. This is because retail traders in the market who enter long trades after noticing a bullish trend in the area around the recent swing low usually place their stop losses below this zone. This creates a considerable amount of liquidity in the form of stop losses within this area. To clear this liquidity, or execute a sweep, the market breaks its recent swing low, triggering an existing trader's stop loss. Two new bearish traders enter the market. This supplies operators with the required liquidity to carry out their long side trades. As soon as this liquidity becomes available, the price performs this downward sweep and moves sharply upward. A liquidity sweep is a form of advanced trap trading. Now let's understand how a liquidity sweep is carried out in bullish, bearish, and sideways market trends. Suppose the market continues its upward trend, forming a structure of higher highs and higher lows. During this phase, many retail traders enter long trades around each swing low. However, when the market reaches a level far above the lower point, the buying interest of retail traders at higher levels slowly decreases. In this scenario, operators and large institutional traders struggle to find the liquidity they require to execute their buy-side orders. To solve this shortage, the market is intentionally driven below previous swing lows. This leads to some new retail traders interpreting this as a breakdown and entering short trades, placing their stop losses higher. This produces a large quantity of liquidity within that zone. The market then sweeps away this liquidity, swiftly reversing and moving upward in the direction of its prior trend. How to avoid this? When the market is in a strong uptrend and the price breaks its recent swing low for the first time, it's wiser to avoid entering a short trade against the trend. This is generally a fake breakdown created to trap retail traders by using greed and fear. You'll observe that near the swing low, either a strong bearish candle is followed by a green reversal candle or a reversal candle with a long lower wick. These are all signals that the price has cleared the liquidity below and is now prepared to move higher again. If you trade very short time frames, such as 1 minute, 3 minutes, or sometimes even 5 minutes, the price often forms 2 to 3 candles beneath the swing low before rising again. However, if you check the same chart on a 15-minute time frame, a long lower wick appears, indicating that price swept away the liquidity below and then moved higher. For example, if you observe this chart, you'll notice that the market was in a strong uptrend from the start of the day. It kept moving upward while forming higher lows. However, after the last swing low appeared, a strong bearish candle broke this swing low to the downside. Seeing this, many retail traders believe that the uptrend has finished. Price has broken not only its swing low but also the recent support. Watching this, many traders, out of excitement, enter short trades without thinking. But shortly afterward, the price reverses quickly and continues its earlier uptrend. The long wick candle that forms here is actually sweeping away the liquidity that had built up near support. This move enables buyers who had taken long positions in the market at lower levels to capture a solid profit. Additionally, the market has already risen enough that retail traders are no longer eager to buy. This is why volatility appears in the market through these brief moves in the opposite direction of the trend on the chart, which brings retail traders back into the market. This is where operators trap them and execute their large orders. Now, let's look at another example. Here, the price is steadily moving upward, forming higher lows. However, after some time, The price breaks below its prior swing low with a long lower wick candle and, after sweeping liquidity, moves higher once again. Observing this breakdown, any sellers who shorted here become fully trapped. You may also notice that the market has not yet broken its previous swing high. This means those who sold here still have their stop losses active. To trigger these, the price sweeps away liquidity and climbs back up. How to avoid such a trap? If the market is in a bullish trend and the price forms a rejection candle near its swing low, you can re-enter a long trade from that point. Your stop loss will be placed beneath the low of the rejection candle, and your target can be set at the recent swing high. This allows you to structure a trade with a strong risk-to-reward ratio by using a small stop loss. Traders, it's finally here. The SMC Trading Mastery course, built to take you from confused to confident. With a complete trading system that actually works. This program breaks down smart money concepts, high probability setups, and real risk management, step by step. And right now, you can grab the entire course for just $500, plus an exclusive 61% discount for early buyers. No tricks, no fluff, just pure trading education. And here's the crazy part. We're giving away 5 $100,000 funded accounts to course members. Don't wait, click the link, secure your spot, and start leveling up your trading today. Now, let's understand how a liquidity sweep functions in a bearish trend. When the market is in a strong downward move, when the price trends lower, it forms lower lows and continues falling. However, at a certain stage, once the price has moved down significantly, retail traders lose interest in short selling. In this condition, the price breaks its recent swing high on the chart, prompting fresh traders to enter the market and, in excitement, begin building buy-side positions. However, as soon as retail traders are trapped, the market shifts back to its earlier downtrend, and the price drops sharply. The key point: liquidity sweeps can develop in every trend. You simply need to recognize the price structure and candle behavior signals. By understanding rejection candles, wicks, and stop-loss zones, you can avoid major traps and execute stronger trades. When a bullish breakout appears in the market, retail traders often enter long trades and end up trapped. But it frequently happens that after breaking above its recent swing high, the price holds above that zone for a while. This breakout boosts the confidence of retail buyers that the market will continue rising. Watching this sustained breakout, new buyers begin purchasing in large volumes. As soon as institutions in this region obtain the needed liquidity to support their selling, the price suddenly drops aggressively, trapping all these buyers. It's important to note that when the market is in a downtrend, it often looks as if the price is breaking the swing high, encouraging traders to take long trades. However, this same move is actually a liquidity trap. Therefore, in this condition, you should look for setups on the chart for short trades rather than long trades. Now, let's understand liquidity sweeps in a sideways market. As the price remains within this range, a large amount of retail liquidity begins accumulating above and below the range. Then, a moment comes when the market shows a breakout in one direction, either upward or downward, and retail traders, excited, enter in that direction. But as soon as liquidity is generated, the price quickly reverses and returns back inside the same range. This is the liquidity sweep in a sideways market, and this trap repeats on both sides. Sometimes liquidity is swept upward and sometimes downward. Many traders fall into this and lose their capital. So what should be done? If you understand such market conditions, you can trade intelligently. Whenever the price breaks out of a range and then returns back inside it, you can trade from that point, setting a small target on the opposite side of the range. But remember that your profit target in such trades will be small. And you must trade with low volume because it is difficult to predict when the price will break out and in which direction. Therefore, entries should be made with full attention to risk management while preserving capital. Conclusion: liquidity traps frequently appear in sideways markets. If you identify these patterns, you can benefit from the volatility instead of falling into the trap like others. That's it, traders. Thanks for watching this video. There's a version of you ahead, stronger, wiser, more disciplined. And every single day, you're getting closer to meeting that person. If today pushed your mindset forward, hit like, and if you're new here, subscribe and ring the bell to stay connected to your growth. Your time is coming, maybe not today, maybe not tomorrow, but when it does, it'll make sense why nothing worked before. Keep going, don't rush the process, trust it. I'll catch you in the next video.